right. Friday night. My favorite time of the week. My Friday afternoon live stream with all you good folks. How's everybody doing today? I hope you are well. Another nutty day on Wall Street, isn't it? Market just all over the place. Up and then down and then down and then up. Man, volatility. Volatility is everywhere. See some familiar names in the chat. Hello, everybody. How you guys doing? Also, hi, Mom. Hi, Dad. I love you guys. So let's get into it, man. What is going on in these markets? First of all, let me just tell you guys, get used to this volatility, all right? Because, well, let's shrink my big, fat melon of a head, and I want to show you this trend in the VIX. Where are you? I had my VIX chart up here. Let's just go back, say, 6 months. Let's go back a year in volatility. Do you guys see what I see in this chart? What's happening in this chart is increasing in frequency, increasing in amplitude, these swings in volatility. All right? The vibrations in the economy, in the markets, are getting worse. And I see higher highs, I see higher lows, and I see these changes, these big candles getting more and more frequent. And this is just a one-year chart. I mean, let's go back 5 years. Right? I see, forget the noise of the pandemic, right? Look here. These candles are getting bigger. Volatility is getting more common. And it's going to be a bumpy couple of days, couple of months, couple of years even. And there's one thing I want to mention is that, I'm gathering my thoughts here a little bit. When you're driving down the road, I used this analogy in an interview with Chris Taylor from Financial Fitness last night. When you're driving down the road and your car starts to make a noise, starts to shake a little bit, and you just kind of ignore it and you keep driving, and the shaking gets worse and it gets louder and it gets bigger, something's about to break. Something is about to give. All right. And if there's one thing that markets need, markets want, it is certainty. Markets like predictability. They don't like unpredictability. Markets hate this volatility, folks. They hate it. And it's not a good sign. This is not a good sign for where the markets are going to go from here. And I just want to tell you, right now we're seeing money is leaving the stock market at an alarming rate. We're seeing money is leaving the bond market at an alarming rate. And we're seeing the beginnings of a turn in real estate. The real estate market looks like it's topped. Foreclosures are on the rise. Mortgage applications are down. So no stocks, no bonds, no real estate. Where else are you going to put your money? Right now, the reason the Dixie is so high, the reason the dollar is so strong is because everybody is running to cash right now. Myself included. Everybody is moving into cash. Well, cash right now has somewhere around an 18% carrying cost because of inflation. The government's official inflation number is 8.5%. Yeah, okay. No, it's really closer to 18%, maybe even 20%. So is everybody going to sit in cash forever and eat this 20% carrying cost via inflation? Or sooner or later, people are going to start to put that money somewhere. They're not going to put it back in the stocks. They're probably not going to put it back in the bonds. Certainly not going to put it into real estate. Gold and silver, folks. Maybe even cryptocurrency. But I'm less excited about cryptocurrency because we're in crypto winter right now. And watch out for that tether story in the bond market. Watch out for that. If the bond market blows, it could take cryptocurrency with it, at least in the short term. But I still buy cryptocurrency in small amounts on a regular basis. But really, the only place left in the world people are going to have to put their money is going to be in the precious metals. And I know you guys, you look at these charts, you look at the silver chart is down like 15 days in a row. The gold chart, gold's not doing quite as bad, but still, gold is hardly where we'd like it to be. These day-to-day swings, I think if you zoom out on the chart, few years from now, they will not even register. You won't even be able to see them on the chart. I think there is so much money is about to flow into precious metals over the next year. It's going to blow your mind. All right. And there's nowhere else to turn. There is nowhere else for the wealth of the world to go for safety. All the traditional avenues right now are selling off. And right now, all that money, because it's figuring out what it wants to do, it's just sitting in cash. Well, it's losing 20% a year, 18% a year sitting in cash. How long are they going to stay there? How long is all that money going to stay in dollars eating that 18% carrying cost? I know I'm not going to leave my cash in place for a year, for 2 years. No way. I'm not going to eat 20%. But right now, the world is holding its breath, waiting for a better buy-in. All right, and that's a self-fulfilling prophecy. If everybody in the world thinks it's going to go down, it's going to go down because there's no buyers. And that's what the problem with this market is. There's no buyers. Unless you were one of these retail guys who FOMO'd in off of the supposedly dovish Fed, I can't imagine anybody watching this channel did that because we said it just didn't pass the sniff test. So that's me. That's my soapbox. Anyway, folks, it is 3:21. We still have about 40 minutes of trading left today. Let's see where we're at. Got to refresh the window. You got to refresh every 5 seconds right now because things just move so fast. Right now, the S&P is down 60, almost 61 points, or 1.5%. Another rough day after a rough week. Just brutal week. And let's see how the Dow is doing. Not faring any better, down 1.19% or 391. Looks like that sell-off might be picking up steam in the close. Be careful of those Friday liquidations. Are we going to see margin calls into the close? This is a good time to talk about margin calls, folks, because this market is built on margin. This market is built on debt. People, more than ever in history, borrowed money to buy stocks, and all that debt is still out there. And those margin calls have not started yet. That cascade, that snowball, hasn't started yet. All right, and I should have put a link in the description, but check out an article that Brian Zarb just did on his channel, not his channel, his website, thetechnicalchartist.com. Absolutely fantastic article that he wrote, and his charts just paint such a gruesome picture of where the market could be heading, because this whole bull run is built on debt, borrowed money that bought stocks. And when those stocks start going down, the people that you borrowed the money from start banging down your door demanding their money back. And they take it. They don't ask nicely. They sell you out and they take it. That hasn't started yet. We may be very close to the level where that starts at. And right now, selling off in the close, now down 400 points. That might start happening while we're talking right now. I don't know. But, hey, let me know in the comments if you see that start to happen. If we suddenly start dropping hundreds of points every few minutes, you know that's happening. And then here's the Nasdaq, the worst of all of them right now, down 275 points or 2.25%. Again, that's after almost a 6% sell-off yesterday. Nasdaq's just got absolutely crushed yesterday. And look, there's a transition in progress right now. The market is shifting from growth to value. Value for safety, and shifting from growth, that's your FANG stocks. Right, that's your high multiple tech stocks. They're done right now. They've had their day. They dominated the market for almost 20 years. Not anymore. Now they're going to be treated like redheaded step stocks. No offense to the redheads out there. And I see Miracle Oil. Thank you so much, Miracle Oil, for the super chat, who says, another great call by Jack. I almost sold all of my puts on Wednesday, but the sniff test told me not to. Do we need to close our XLE USO position? Do you suggest adding XLF put? XLF, that is the financial sector, okay. Can you do the charts for each? Where do you think QQQ and IWM can head down to? I don't follow IWM that closely. QQQ, I think, is heading much, much lower. I think that is a multi-year bear market we're in for QQQ. So I don't see anything good shy of the Fed turning the printer back on, which may or may not happen. It won't happen anytime soon. QQQ's heading lower, all right? QQQ needs easy money to go higher, and they're not getting it, not for months. An XLF put, that is an interesting thought. XLF, that is your financial sector spider ETF, and I think that one probably goes lower from here because we've got sell-offs in the bond market. Debt is getting more expensive. Credit default swaps for bank bonds are going up. They're at their highest level in years right now. And credit default swaps, that's insurance on bonds. So trouble in the bond market is trouble for the financials. It's trouble for the banks. So I don't think that's a bad idea. Again, not financial advisor, not financial advice. I have not closed my XLE position. I do have my XLE chart up. Let's take a look at XLE. Where was XLE? Here we go. I've got my XLE chart up. So we are back above that trend line in XLE. Make sure you guys can see. Oh, look at my face in the way. You can't see. See, this is why we check. All right, so we're back above that trend line that I drew a few weeks ago in XLE, where I like to see it. I also mentioned a couple weeks ago when we broke down in the chart that I thought it was encouraging that this 50-day moving average had acted as support, and looks like we hung out down there for a couple of days. We've moved higher. So XLE seems, technically speaking, XLE looks good to me right now. All right, I like the direction we're in. I like that we're back above this trend line. Now, if you want to know, this is oil stocks, right? So this is not oil itself, XLE. This is made up of about 50% of this fund is Chevron and ExxonMobil, and the other 50% is a mix of exploration and petroleum companies, right? So as the indexes get dragged lower by this widespread sell-off in stocks, it could put pressure on XLE. It's important to know that, all right? If the whole market catches fire, XLE could get taken down with it. So keep that in mind. But also keep in mind that underneath these stocks, supporting their prices, is oil prices. All right, and now here's looking at oil futures right now. And I drew this pennant pattern. I actually drew this today. I adjusted it. A couple of weeks ago, I drew a pennant pattern that was a kind of closer like that. But I've adjusted my chart now, and it looks like we've just broken out of that pennant pattern, which is a continuation pattern and a signal that this previous trend is going to continue. And if you look at the previous trend, going all the way back to the fall, that means oil is going to resume its steady grind higher. Maybe not shoot up like it did in March, but upward and to the right, slowly and steady. And I honestly, short of wholesale demand destruction, like we could see in China, or like, entering a depression might produce, I think oil prices still go higher from here. Keep in mind, though, if we get a massive, massive sell-off in stocks, right, like the mother of all sell-offs, 2008, 1929, something like that, oil stocks are probably going to get dragged down with it, and we're probably going to see oil futures sell off, even though it's not going to bring any new supply online, but it's going to be demand destruction. All right, so as oil is marching higher, make sure you're booking profits. Don't pig out on these, all right? It could go higher for much longer, but at the same time, this one could get dragged down with a wider market sell-off. All that said, I'm still in my XLE puts. Not my XLE puts, I'm sorry, my XLE calls. I still have calls in XLE. As they have been going up, I've been taking profits, and then some of the profits I've rolled into other call options further out, and I've also taken some cash off the table. So just make sure you're taking profits in this one because the market could drag this down with it. Thank you very much, Miracle Oil, for the support of the channel. I appreciate that very much. And CS2 says, the super chat and its sender are calm and stable. Is that what CS stands for? Calm and stable? By the way, CS2, any relation to the Bitcoin loathing CS who was often on this channel? I don't know. But anyway, thank you very much, CS2, for your support of the chat. And I congratulate you on your calmness and stableness. These are trying times. Not an easy time to stay calm and stable, not with volatility moving the way it has right now. Speaking of volatility, let's check in on the VIX. Looks like volatility has given back some of its gains today. That probably means the indexes are heading higher right now. Hard to believe, but there it is, a little bit higher. And the Dow, let's see, the Dow is now down 328. Looks like a little bit of life left in the indexes today. I don't know. Are we going to rally into close? Are we going to sell off into close? Hard to tell. These markets are very much unpredictable. Looking at the U.S. 10-year Treasury today, that was kind of a sign that we were in for a wacky day when I woke up and saw, what were we, 312 in the morning, sold right off, or not sold off. I guess that's buyers coming in when you see yields dropping. But look at this nonsense in the morning, down and then up and then right back down and then all through the day bouncing around. This is the 10-year Treasury. This is the debt instrument that the whole world watches and pays attention to. You don't want to see that kind of volatility in the U.S. 10-year Treasury. And it just continues to grind higher, now at 3.12%. And if you would have asked me a couple of months ago, I would have told you no way does the 10-year ever get this high. I thought for sure something would have popped way a long time ago. I mean, I said on this channel for the longest time that 2.2% was probably where something was going to pop. Obviously, that didn't happen, so I got to eat some crow on that one. But we are just so high above this 40-year trend in the 10-year Treasury yield right now that, in my opinion, it's not going to take a lot to set this whole thing on fire. And what am I talking about here? It is time to look at the chart of charts, the one I have been showing for a long time here on this channel. And that is the declining trend in the U.S. 10-year Treasury. And this is Carter Worth's chart, not mine, because when you set it to a logarithmic scale, it falls right into place neatly. And every time we go near this trend line, something very bad happens in markets. And look at us right now, way above that trend line. So to me, this sudden shift, right, the fact that we're so high above this trend line, combined with this increasing frequency and amplitude in the VIX, in the volatility spiking, right? This trend is over. The era of free money is over, and it's this inflation problem that after 40 years, 42 years, whatever, is finally caught up with us again. That's what's put this to bed. That is the "it's different this time" excuse, because all these other times when we had these market events and the Fed came into the rescue, they came in with easy money policies to save us. The problem is we're going into this event with easy money policies already in place because of what happened in 2020. So they can't ease right now. The dollar is dying, and 50 basis point rate hikes, 25 basis point rate hikes is not enough to slow the trend of inflation. The only thing that's going to stop the trend of inflation is going to be a massive economic collapse, unfortunately. And, you know, the more I think about it, the only bullish case I can see for stocks, all right? And, you know, I sit down and I list the pros and the cons of what could take markets higher, what could take markets lower. And the only bullish case I see for anything in the stock market right now is the prospect of the Fed turning the money printers back on. It's the only thing I can see possibly doing anything to reverse this trend. I don't think they can turn the money printers back on right now. The public is demanding that they fight inflation. And so they're doing their 25 basis point rate hikes, their 50 basis point rate hikes, right? Which I have to say, in the face of 18% real inflation, what is a quarter of a point rate hike? What is a half a point rate hike? It's nothing. All right. That is not nearly enough to change the dynamics of inflation. All right. The only thing that's going to change inflation is if interest rates go above the rate of inflation, which, hey, that's what Paul Volcker did back in 1981. No thanks. Or some kind of major market calamity. And I think that is what's happening. And I think the Fed knows that. And that's why all the Fed governors sold their stocks back in August. Or maybe we could take them at their word. And it was just to eliminate the appearance of a conflict of interest. Well, they weren't so worried about the appearance of a conflict of interest when they bought those stocks, were they? No. Now that they're about to crash markets, now they're worried about the appearance of a conflict of interest. So a lot of people don't believe that the Fed would intentionally crash the stock market. Well, they sold their own stocks, folks. So believe them, all right? When someone votes their own wallet, you better believe them. I see Mr. Mike Binder from Robin RC Models. Thank you, sir, for the super chat. He says, Jack, the actual average shipping time from China to U.S. is at an additional 74 days at the moment. Let that sink in. 74 days. Almost 3 months or 2.5 months. Now, you said, Mike, that's an additional 74 days? As in 74 days above average? Wow. That's how bad this lockdown is in Shanghai and Beijing and Shenzhen, and this ridiculous policy that Xi Jinping has put in place for whatever reason. Now, that's interesting, Mike, and that's an excellent segue. Thank you for that. Because a lot of the talking heads on CNBC and in financial press, when they got that negative 1.4% GDP number a couple of days ago, when in my opinion, that was the beginning of a recession. And it's not a recession until you have 2 consecutive quarters of negative GDP growth. So by the time you find out you're in a recession, you've already been in it for 6 months. All right, so we're now 3 months into it. A lot of the talking heads in the press just said, oh, that's just noise because there was inventory reductions. Because of supply chain issues, all the retailers and everybody in the United States had built up their inventory in December, and then in the first quarter that inventory fell, so that looks like economic contraction. Well, while that may be true, when they dismiss this inventory reduction as a one-off, that's overlooking the fact that people can't replenish their inventory right now if they tried. And look no further than Mike Binder's super chat. 74 additional days to get a cargo container from China to the U.S. All right, so if all these talking heads in Bloomberg and CNBC who said it's just a one-off, it was only inventory numbers that skewed, and even Jerome Powell said that on Wednesday. Even Powell said that he wasn't overly concerned about the negative 1.4% GDP print because it was affected by one-offs and inventory. That inventory is not coming back. I'm telling you, folks, we are a couple of weeks away from bare shelves. I just came from a meeting at my firehouse on last night. We were talking about buying a new off-road vehicle, a UTV they called it, for doing rescues on a hiking trail. Because we have hiking trails through our area, and if we ever have to carry somebody out of a trail, the big rigs can't reach them. It's a long walk, and let's just say it's not easy to hike in that firefighting gear, all right? You sweat like a pig in that stuff. So they're talking about getting one of these UTVs to do rescues in the woods. And the chief said, we need to place the order now because the lead time was 285 days. And they would quote us a price, but even if we put a down payment down, we couldn't lock in that price. So they won't guarantee what the price will be in 285 days when this vehicle finally gets here. That's how bad the supply chain is. Almost a year out to order this stuff. So these inventory problems, the fact that they're saying, oh, the GDP is going to get better because the inventory was low and that's going to fix itself next quarter. No way. That is going to get worse next quarter. And look at those boats sitting outside Shanghai right now. And that just tells you. The supply chain, I mean, how long have they been saying we expect these supply chain problems to be resolved in short order? They've been saying that for over a year now. And it's only getting worse. It's only gotten worse. The whole time they've been assuring us that just over the horizon, the supply chain gets better. It continues to deteriorate. It's not getting better. It's getting worse. And another thing, while we're on the subject of GDP, thank you again, Mike, for the support of the channel and for your awesome comment. Sorry, you got me all spun up there. Speaking of GDP, nobody's talking about what the strong dollar is going to do to U.S. company earnings. Because our companies that do business overseas, take Apple, for example. Apple sells iPhones in China, assuming anybody's even allowed to leave their house and buy an iPhone in China. Say somebody buys an iPhone, they buy it for yuan. Well, Apple brings that money back to the States. They exchange the yuan for dollars, and then they report those dollars on their quarterly earnings. But those yuan now are worth less dollars. The price of the iPhone hasn't gone up, but the amount of dollars you get for those yuan has gone down. So Apple takes a hit on their quarterly earnings from foreign exchange rates. You're going to hear that described as Forex headwinds. And every multinational company in the S&P 500 in their second quarter earnings conference call is going to talk about how they took a so many percent hit to their bottom line because of Forex headwinds. It's going to drag company earnings even lower. So this recession that we're in, not technically a recession yet because we haven't entered our second quarter. It's only going to get worse next quarter. It's not going to get better. All the excuses that are being trotted out by these muckety-mucks in the financial press and at the Federal Reserve, and various government officers who want to assure us that it's just a fluke, that it's just noise. They're wrong. It's going to get worse in the second quarter. And there is my friend Matt, the cheeseburger. Hello, Matt. He says, man, getting into this market right now is like trying to cross an 8-lane highway at rush hour. Yeah, I don't recommend either. Let's just put it that way, Matt. And I have this image of Cheeseburger playing Frogger, going back and forth trying to cross an 8-lane highway. That was a great clip in Seinfeld when George Costanza had the Frogger machine hooked up to a car battery to preserve his high score. That's Cheeseburger trying to cross his 8-lane highway. Thanks, Matt. Appreciate the support of the channel, brother. All right, we got 20 minutes of trading left in the day. Let's take a look at where we're at right now because, again, you got to check like every few seconds. Well, it looks like the S&P is breaking higher. Look at that. Wow, where did these buyers come from? Now only down 19 points or 0.5%. Look at the buyers buying up the S&P. I'm not one of them. I don't know who it is. It's not me. And the Dow, the same thing. Now only down 100 points. All right, Dow rallied 200 points into close. There's still 20 minutes of trading left. Let's see where we go from here. And the Nasdaq, Nasdaq's not doing quite so well, but they got a little bit, caught a little bit of life, down 171 or 1.39. Again, the volatility in these markets, there's no telling. There's no telling what it's going to do. And the 10-year yield is now at 3.12, up 5.7 basis points for the day. Again, that 10-year. Look at this 1-year chart of the 10-year Treasury. Look, to the day. Look at this chart. I got to put it right on January 1st. First, I got to get my melon out of the way. Keep putting my melanin away here. Look at January 1st on this chart. Where are we? I mean, it's as if the powers that be right here, right at this big green candle right here, it's as if the powers that be just decided, you know what, folks? 2022 is the year the market crashes. Because look at what the interest rate on the 10-year Treasury has done since January 1st. I mean, boom, the clock goes to 2022 and rates start marching higher. And they haven't paused for more than a week or so at any point all year long. Just up and to the right, straight up. It's as if this is planned, isn't it? It's almost as if, I don't know, say the people who control monetary policy sold all their stocks in August and decided they were going to crash the market on purpose. I just throw them out there. You guys do what you want. I just throw them out there. By the way, while we're on the subject real quick, I have to pause and I got to say, send a shout out to my man, Mark the Stump Grinder. Mark, I saw you in the chats earlier today. I don't know if you're still here, but check out what Mark the Stump Grinder sent me. Mark likes to work with wood, and he sent me this hand-carved wood bowl made from an oak burl. The camera doesn't do it justice. The finish on this thing, you need sunglasses to look directly at it. This thing is just fantastic. Absolutely beautiful. Mark made this and sent it to me, and he was also nice enough to throw a couple of ounces of shiny in there for my girls. You should have seen my daughter's eyes light up when I handed them their first silver rounds. So, Mark the Stump Grinder, thank you, brother. I really appreciate that. That was a very, very kind gesture. Thank you for doing that and for your support of the channel. And by the way, I sent you something in your inbox, Mark. Take a look in your email when you get a chance, if you're still on here. And fine bit of work, man. Mark is a talented guy. I don't know how he got the wood into that shape. You gotta explain to me how you got that shape, Mark. I don't know how you did that. Anyways, let's take a look at commodities real quick, folks. We haven't looked at this. All right, gold and silver pretty much flat for the day. We talked about oil already, marching higher. Natural gas, not so much. Natural gas down 8% today. Let's look at the gas chart because, natural gas was just on a tear really since the start of the year, right? Look at the natural gas chart. Got to check my melanin away. Nope, you guys can see. So this is U.S. Henry Hub natural gas, or the price of gas here in the States. Straight up all year. There's that big spike in March when the Russians got froggy. We came back down, and we broke above $9 on natural gas futures. Now, big sell-off today, over 8%. Big red candle down. Is that the end of the chart? I don't know. Probably not. I don't think there's been some big discovery of natural gas, or there's no new pipelines getting built. There's no new wells getting dug. So I don't know what to make of that sell-off today. But the reason why I mentioned this is because one of the companies I've been following on this channel for some time has been LNG. And I sold my LNG about a week and a half ago. I probably shouldn't have. And looking at this chart, I definitely shouldn't have sold my LNG. I think this one can still go higher, even though I'm no longer holding it. And I tell you, if I got an opportunity to buy this one back, I probably would, because we're right back into this channel that I was talking about for the whole first quarter of the year, really. I sold when we dipped out of it, and now we're right back into it, trading well above our 50-day moving average. Now, Cheniere Energy, ticker LNG, they buy U.S. natural gas for very cheap, or at least what used to be very cheap. It used to be $3 per million BTUs. Now it's 9 or 8. And they ship it over to Europe, where they can sell it for like 28 or 29. All right. So it's an arbitrage play on the difference between European and American natural gas prices. All right. And it's a good bet that higher gas prices in Europe are here to stay. I don't think things in Europe are going to get better anytime soon on the natural gas front. Now, this is the chart of ICE Dutch TTF natural gas futures. All right. This is the benchmark European natural gas price. All right. Significantly higher than the American price. But the one thing I want to point to, speaking of increases in volatility, you'll notice these previous spikes and that they got bigger in nature, right? And again, the sign of a trend that's about to break is increases in volatility, increases in frequency, and increases in amplitude. Well, we're about due for another one of these big spikes in European natural gas, aren't we? Just looking at this chart, it was, the end of September was the first one. And then mid-December was the next one. And then the end of February, right? So they're just about 3 months apart each time. And now here we are, the beginning of May. The last one was at the end of February. I would not be surprised within the next couple weeks to see another spike in these ICE Dutch natural gas futures up into the 200, maybe even the 300 range. It just seems like we're due. And, the more I think about it, what has changed? The fundamental story on the ground with European gas prices. The language has gotten stronger, right? The politicians say, we're not going to use any more Russian gas, and then all they do is turn around and buy it from somebody who bought it from Russia. So they're just going through a middleman and then congratulating themselves on virtue signaling for the benefit of Ukraine, right? They're still buying the Russian gas. They're just overpaying for it. So keep an eye on this chart. Something tells me something could be about to blow in these European natural gas prices. It seems like we're due for it. And I see Mike Bender again from Robin RC Model says, thanks to the tools of monetary policies. Yeah, there's those tools, Mike. We're going to have to add to the tool counter. Many equities and commodities are completely mispriced, due for a reset, and likely sooner than most think. I think you're spot on. You're right. These monetary policies are broken. And really all these monetary policies have done is they've inflated asset prices to the benefit of the ultra wealthy. That's all this easy money has done. All right. It's inflated away the savings of the middle class. It has driven the poor further into poverty by increasing their cost of living through inflation. And it's made them, the wealthy, extraordinarily wealthy because they own the assets that are now inflated in price. However, what we're seeing right now is this dumping of assets. This asset bubble is about to burst. It's about to pop. It's probably not going to be today, just based on what I saw the markets do in the last couple of minutes. And where's that money going to flow? I was talking about it at the beginning of the stream. I think that money is going to flow into precious metals. I think it's the only safe haven that's left. Commodities are going to rip higher. The price of everything is going to keep going up. Brian Zarb said it on that interview series that I did with him. He said, commodities is a bullseye at the center of this monetary target, and at the center of that bullseye is gold and silver. And I think gold is going to be the primary beneficiary of this, and by default, silver. Silver may actually go up higher in percentage terms because, in my opinion, silver is more suppressed, more undervalued. But you have to keep in mind that industrial demand is probably going to shrink for silver as there's just widespread economic calamity going on around the world. The industry is going to use less silver. I know a lot of the silver bulls may disagree with that. I see industrial slowdowns happening across the board. So that could hurt. That could be a headwind for silver, even though the tailwinds of this just deluge of money into precious metals is probably going to drive it higher. But thank you, Mike, again for your support of the channel. And there he is, Mark the Stump Grinder, helping to feed the chickens for 20 days. Thank you, Mark. I have gotten my my chicken feed cost down to about $1 a day. I give them some table scraps. I feed them a lot of the the weeds that are growing in my yard, which, my God, there's no shortage of weeds growing in my yard. I have so much yard work to do. But it's costing me less than $1 a day to feed my chickens. So thank you, Mark, for 20 days of chicken feed. I appreciate that, brother. And thanks again for what you did. I don't know if you were here when I showed you that, but I was flashing your bowl, Mark, on my live stream. I have it right here. Absolutely gorgeous. Fantastic work, man. Thank you so much for doing that. Thank you for that nice gesture from my girls. It made their day. And they made a wonderful mess in my kitchen with all the foam and the bubble wrap. They always play with the packaging, don't they? Anyways, thank you, Mark. I really appreciate that. All right. Let's take another trip through the indices, see where we're at. It's a volatile day. We're going to revisit the indexes a little more because it's just so dang volatile today. Right now, the S&P down 12. It might just barely close in the green. Let's see. The Dow down 38. And the Nasdaq still down pretty hard. The Nasdaq is being held down. Now, if there's one index that should underperform, it should be the Nasdaq. So, that's what you want to see. Down 1.2%. Oil still grinding higher, up $2.33 a barrel. And precious metals remain in the doldrums where they won't stay for very long. All right. I haven't talked about the agricultural trade for a while. That's one of the commodities that I think is probably the one trade I'm most confident in is the agricultural trade. Even though it's on something of a breather right now, I'm not terribly worried about that. Let's look right now. This is our fertilizer prices. DTN retail fertilizer trends. This is dated 2 days ago. Fertilizer prices are still higher for last week. This is, when I say last week, the 4th week of April, but not higher by much. They didn't go up that much in April. All right, 6 fertilizer prices were higher, but none were up significantly, and they define significantly as 5% or more. Diammonium phosphate was at $1,049 a ton. MAP was at $10.82 a ton, an all-time high. Potash, $8.81. A couple of the various combinations. Anhydrous, an all-time high. UAN, an all-time high. So a lot of the fertilizer prices still going up to all-time highs week after week, although a little bit of that momentum bled off. Could we be approaching a top? Personally, I don't think we're anywhere near a top in fertilizer production because no fertilizer plants are getting built. No new gas pipelines are getting built. All the things that are making fertilizer more expensive continue to get worse. And I tell you, I saw some stories over the last week, an article on freaking treehugger.com that was talking about how the increases in fertilizer prices are a good thing because it's going to lead to more sustainable agricultural practices that use less fossil fuels. It's great. Congratulations on your sustainability. Hundreds of millions of people might be starving to death next year, but Tree Hugger's happy because less fossil fuels are being used. So when you see stupidity like that running rampant among damn near a third of the population, you know our leaders are not doing anything of any substance to make any changes. All right? When you see that kind of nonsense being put out, and I'm hearing this crap in the press also, they're trying to spin the narrative that there's a silver lining so they can get away with doing nothing about it. And it's not going to be that big of a problem here. Sure, we might have a few riots, a few people might get killed, food prices might skyrocket, everybody's life gets miserable, but the real mayhem from a food shortage, it won't be here in the States. Probably won't even be in most of Europe. It's going to be in Africa. It's going to be in Southeast Asia. It's going to be in the Middle East. That's where human suffering will be unbelievable. That's when the cameras get turned off because people are sick of seeing it on TV and they don't want to be reminded about it. It's going to get that bad. And honestly, that's not economic speculation on my part. At this point, it's biology. There's less nitrogen, less phosphorus, and less potassium. There's going to be less food grown. It's biology. It's not math. It's not economics. It's not charts. It's simple biology. Plants need nutrients, and they're not getting them. And I see Cheeseburger again with the super chat. Thank you, Matt. He says, do you follow Peak Prosperity? The video, Are We Going to Starve to Death This Year from earlier in the week was really interesting. No, I don't follow Peak Prosperity. I'm going to have to, that's a new one to me. I'm going to write that one down, Matt, and I'm going to check that video out. Peak Prosperity. I love prosperity, but I didn't see a video like that, so it must be another channel. But I'm going to check that one out. Thank you, Matt. And I will let him know that Cheeseburger sent me. Cheeseburger, who is famous from the 3MRI video. All right. Thanks again, Cheeseburger. I really appreciate the support of the channel, brother. And here is the corn chart. This is the corn ETF, not the corn futures. Again, this is the ETF I've been trading. I own call options in this. I put in some orders for calls. Well, I have several calls that expire in August, and I put in some orders for January right before this stream started. I don't know if those filled or not. But we are right here, right around this support line that we've traded at a couple of times since this monster run started at the beginning of the year in corn. We're actually a little bit below it. I'd like to see it close above that, but I'm not freaking out yet. We're still well above our 50-day moving average. All right, so corn has been consolidating really for the better part of a month. Now, we're at something of an inflection point right now, right? Keep in mind, the corn trade has always been, to me, about the fertilizer story because corn uses more fertilizer than all the other major crops. All right, the Ukraine thing was always just an additional story on top of the fertilizer story. And then we had a bad South American corn harvest. That was another benefit. Now we're into the point where we're late in the U.S. planting season. All right, it's been too cold and too wet for most of the country to plant corn. Only 14%, the last time the USDA released one of their estimates, only 14% of U.S. corn had been planted. That was as of a few days ago, where this time last year we were at 42%. All right. Now, the important date is May 20th. All right. May 20th is when the planting season is officially over. That means farmers are down to 2 weeks. If weather doesn't get drier and warmer over the next 2 weeks, then we are going to see even further declines in yield in the corn crop because of late planting. All right. We're still at the point now where a late planting season will not affect yield, but we're close. We're very close. And it takes about 2 weeks to plant. All right, so there's not a lot of time. It looks like by mid next week, and one of the reasons why corn is down today pretty substantially is because it looks like mid next week it's going to get warmer and drier, and they're going to have a window where they can get some planting done. All right, if that changes, if things get wetter, if things get colder, and weather can change on a dime, weathermen are wrong all the time, then the situation in corn markets is going to get even worse, and that's going to be yet another tailwind pushing corn prices higher. All right, now, that being said, regardless of the late planting season and the weather next week and the week after, the corn trade has always been about the fertilizer situation. And we know, based on some of the last estimates that the USDA put out, that there's going to be about 4 million fewer acres of corn planted this year. Now, even though there's going to be 4 million fewer acres planted, and even though the farmers who do plant it are probably going to apply less fertilizer, the Department of Agriculture is still forecasting U.S. corn yields will be as high as they were last year when we had a bumper crop. All right, and that, to me, does not pass the sniff test. All right, I've mentioned the sniff test before. 4 million fewer acres, and then of the acres that are planted, less fertilizer used. There's no way we're going to get as much corn out of the ground this year as we got last year. There's just no way. It's simple biology. It's simple math. All right, you throw on top of that a late planting season that may or may not happen, even worse. You throw on top of that no Ukrainian corn hitting the market, and other countries that export food are now hoarding their exports to try to suppress their own prices within their borders. There is just a perfect storm. There's this whole big recipe for higher corn prices. I am still very much into this trade, and like I said, I just put an order in right before this stream started. We'll see if that fills or not. But we're right here, right around this line of support. I think corn is going higher regardless of what it does in the next week or two. All right, and then here we go. This came out just today in Bloomberg. Chicago corn and soybean prices snapped a 2-day rally on optimism that U.S. farmers will be able to make up for lost planting time starting next week. This is dated today. Rains and chilly weather have kept many producers out of the fields during a critical period for getting seeds sown in time for a full growing season. But a forecast for drier and warmer conditions across key regions starting this weekend should give farmers a window for field work. Should give them a window. That's not to say the late planting season is done. All right, so just something to keep in mind. All right, now let's real quick. It is now 4:00. The market is closed. Let's see what happened into close. Looks like the Nasdaq closed down 1.73 or 173 or 1.4%. Another bad day for the Nasdaq. The S&P did not manage to close in the positive for the day, down 23 points or about 0.5%, although not nearly as bad as it was, now at 4123. And the Dow down 96 points or 0.29%. Again, looked like they were trying to stage a rally late in the day. They didn't quite pull it off. So thus ends an absolutely wild week. My God, what a nutty week that was. 1,000 points one day, 1,000 points the next, 500 the next, just one after another. Get used to it, folks. Again, volatility is here to stay. And increases in volatility, increases in the amplitude and the frequency of these big swings just goes to show you that there is a change in the overall trend that's coming. And in my opinion, this is signaling the end of the era of free money. And again, the only really silver lining I see for markets right now, the only bullish case for stocks is the prospect that the Fed will turn the printer back on at some point, that the Fed will ease off of the rate hikes and that they'll start printing money again. I think that is still months away, at best, months away. They need to see a couple of consecutive prints of lower CPI before they can do that. And I think they need to create this public outcry for it, right? And the public isn't going to demand it. Right now, the public is more worried about gas prices. They're more worried about their food bills going up. But when people start losing jobs, when people's retirements start going away, when people's homes are worth less money, then we'll see what they ask the Fed to do. And I think the Fed will turn the money printers on because we beg them to, not because they want to. Although they do want to. It's what they've wanted all along. But they knew they needed to create those conditions in order to get the public mandate to do so. It's why they sold their stocks in August. It's why they're hiking rates right now. Their plan is to eventually inflate away the debt. And I see Mr. Robert Von Bursch. Thank you very much for the super chat, sir. He says, hey, brother, great show. Check out AMHPF. Thanks. AMHPF. I don't know what that one is. That is a long ticker. AMHPF. I'm going to do this one on the fly. Verde Agritech. Oh, I hit something else. Low market, 377 million. I don't know this one. That is a wild PE ratio. Is that accurate? 141 times earnings that's trading on? If that's accurate, I'd be a little suspicious of that one. What do they do? Agricultural technology company produces and sells fertilizers in Brazil and internationally. Okay, it's a fertilizer company. I see. Obviously. So without being able to comment specifically on this particular company, all right, I can't comment on this particular one. I don't know who their CEO is. I haven't looked at their financials or anything. That 141 PE, that worries me. All right, that's kind of a red flag for me, seeing a PE like that. But I don't know anything about the company. I can tell you the space as a whole, an agricultural company dealing in fertilizer right now, at least as far as the sector goes, that's a good play. All right, non-financial advisor, not financial advice, all that CYMA stuff. Keep an eye on that PE ratio. I don't know if that's accurate. That's what Yahoo Finance is giving me right now. And it's had a monster run. I mean, wow, from $1.74 to $7.50. I don't know what your entry point was, but if you bought in before this big monster run, I mean, can't get hurt pulling out your cost basis and then leaving the gains on the table. Play with the house's money, so to speak. But thank you very much, Mr. Robert, for the super chat. I appreciate the support of the channel, brother. All right, folks, it is 4:04. The weekend is upon us. Good riddance to this week. I'm not going to miss it, but you know what? We're going to have another big volatile week next week. That's for sure. By the way, I have another video coming out in a couple of hours today. I just wrapped up editing it earlier with the Economic Ninja. We were talking about commercial mortgage-backed securities, or CMBS. So look for that one. Probably post that in about 2 or 3 hours. And I want to thank you guys for joining me. Thank you, everyone, for your generosity in the super chats. Thanks to Mark Stumpgrinder for the care package, sir. That was awesome. I appreciate it. And thank you to all my Patreon supporters. Couldn't do this without you guys. There is a link to that down in the description below if you want to check that out. And with that, I hope you guys have an awesome weekend. Remember, I've been saying it for weeks, difficult times ahead, but they're not here yet. So in the meantime, hold your loved ones close. Enjoy these good days while you can, because it may be a while before they are this good again. And oh my goodness, snuck in right before the send-off. Free like summer, sneaking in another super chat like that. You stepped on my send-off, Free. Free like summer says, hey JG, just a quick update from Bulgaria. Last week, Russia shut off the natural gas. This week, the parliament voted for sending weapons to Ukraine. The majority of people don't want that. That's interesting. It does seem like our leaders on both sides, be they American, European, Russian, Chinese, it seems like all of our leaders want confrontation. Doesn't help anybody. I don't. Again, when things are getting so bad, when you're worried about your own political career, start a war and reflect people's anger outwards. Unfortunately, history has shown us that this is what powerful people will do time and time again. And I hope I didn't just land myself in another 30-day shadow ban. Oh, this is day 32. About a little over a month ago, I did a video about the World Economic Forum, and I got a little slap on the wrist from the algorithm, and they stopped showing my channel to anybody new after I did that. I guess they didn't like that one. So hopefully I didn't just land myself in YouTube jail again. But I'm sorry to see that, Free. I'm sorry that your natural gas is going up in price, and I'm sorry that it seems like our leaders want to march us all off to war. All I can tell you is reason will prevail eventually. Be a voice of reason in the crowd of nuts. And thank you very much for the support of the channel and for the update. I really appreciate that. All right, guys, I want you to have an awesome weekend. Again, difficult times coming, but they're not here yet, so enjoy these days. It's going to be rainy here, so I am going to sit with my ladies and watch a movie tonight. They've been asking me to watch this new movie for quite a while, so we are going to go down in the theater and enjoy that. And until next time, live small and dream big.